Okay, so I put away the example PDF out of the book, and now we're just going to work in Excel for a little while, and I want to talk about how to go about making sense out of this. Now, the first thing I should note is that while I was off camera, I went and made this table look like the one in your book, which is table Exhibit 12.1, Relevant Cash Flows for Supreme Shoe. And so this is what we're working with here. And remember, what we want to get at in this video is how to sort of put numbers to these three items, the initial outlay, the after-tax cash flow, annual, and the terminal cash flow. So let's first look at this initial outlay. So the initial outlay is the price of the project plus shipping plus install plus training minus the salvage value and the taxes on salvage plus the change in net operating working capital. Okay, so what I want to do, I think we can do this with color coding. So let's color code the initial outlay. We'll make it sort of orange. All right. And then let's go ahead and see if we can find the relevant data that indicates or that is involved in the initial outlay. Now, obviously for the initial outlay, we've got the price of the project. So color that one peach. And the shipping and install, color that one peach. Now, we don't have any training involved here. Let's look, though, at the salvage value. Right, so we are going to get a positive cash flow for the salvage of the old machine. Right, that's pretty easy. So we're going to have a negative cash flow of 75 plus 6. And then we're going to have a positive cash flow. Let's indicate that here. This is going to be a positive cash flow, but, right, you are going to have to pay taxes on the difference between what the book value is. You're essentially making a profit on the sale of this old machine. Right now, you're carrying it on the books at $20,000. You're going to sell it for $22,000. And so what that means is that, let's see, we need to pay taxes on the difference. Right, and so we're going to calculate that as, it's going to be the marginal tax rate times the difference. So additional negative cash flow due to taxes. All right, so that is sort of needs to be added in here. So you'll notice that this term up here, salvage value minus taxes on salvage, right? You're subtracting a negative, so it's another positive number in here in the positive statement of the negative cash flow, right? It becomes kind of complicated to remember what direction your numbers are going in, right? So let's just calculate something that's called the net tax flow, the net cash flow from salvage, which is going to be that 22,000 positive cash flow minus the additional taxes we have to pay. So it's 21,320 positive cash flow, which offsets all these negative cash flows associated with the investment, right? And then the change in net operating working cash flow. Okay, what that means is that because this machine is more efficient, we wind up having to buy more raw materials in order to be able to use it properly. So that is another negative cash flow, which we're representing as a positive number here. So the net initial outlay. Okay, let's make a whole lot of lines here. The price of the project, shipping, install, salvage, taxes on salvage, and change in working capital. Okay. So, price of the project here. And this is something where, this is sort of the beginning of your professional portfolio piece, right? Because a lot of times in this book, when you just follow along with the examples, he tries to keep too much information in too small of a space, and it's hard to follow what he's done unless you're actually doing it at the time. So we want to explode out some of these calculations so that we can really see what we're doing. Okay, so that's that. Salvage. Okay, so that's a negative salvage. And then the taxes on the salvage. That. The change in working capital is a negative cash flow as well. So again, we are representing all these negative cash flows as positive numbers for our convention here. So now our initial outlay is going to be the sum of all of these. $62,680. So this is a negative. Okay, so actually let's make this negative the sum of all of those. Okay, so there's our initial outlay. Make that bold. Put a line under this. Pause the video. Let me gather my thoughts. Okay, so now we got to look at the after-tax cash flows. So if we go up here again, right, and we look at how we're defining the after-tax cash flows, right, it's defined as the change in revenues minus the change in net expenses minus depreciation times 1 minus the tax rate plus the change in depreciation minus the change in net operating working capital. Okay, that makes no sense at all, does it? Let's just go ahead and do the example and maybe it'll start to make a little bit more sense, okay? Okay, and so these take the form, in this case, right? So I calculated up here, I put in the difference. And so, these are all down here, the depreciation as well as the maintenance expenses and whatnot, and the salaries you don't have to spend, right? Salaries, maintenance, and defects are all of our sort of before tax benefits from using this machine. So now that's the first thing to note. In this case, it's savings relative to the old machine. Okay, the old machine required us to pay somebody to operate, and it also had a higher maintenance and defects expense to the tune of $32,000 here, right? So let's calculate the total pre-tax savings. Here was it's the sum of those three. 32,000, and then take out taxes, so we'll say after taxes, and this is going to be equal to this number times, make a parenthesis, 1 minus the tax rate. So it's $21,000 after tax that we're going to be saving every year in actual operating expenses. In addition, okay, we are going to have an additional depreciation expense of $9,200 every year. Now, depreciation is a non-cash expense. That means that we gain the tax benefits of depreciation of that operating expense without having to actually pay cash for those tax benefits. That means that we basically are getting back into our pockets the taxes that we don't have to pay on that depreciation expense. So that means then that we're going to take that depreciation increase and multiply it by the tax rate to get the after-tax cash benefit of depreciation expenses. And we take that as a positive number. So we're going to have to, let's see, first of all, we'll make it $1 so I can see what I'm doing. And then what we have to do is multiply, we have to make this a negative number because we are multiplying a negative by a negative. That gives us a positive. So this is positive cash flow due to tax benefits of increased depreciation expense. Okay, so that means, right, that our annual after-tax cash flows are going to be that 2,100 plus 3,128. Make that bold. So every year, right, we're going to have $24,248 more coming into our pockets as a result of this new investment. Okay, so that's how you calculate your after-tax cash flows. Okay, so once again, I'm going to hide some of these intermediate calculations so that we can now look at the terminal cash flow, which is quite a bit more simple. Now, go back up again and look at this formula up here. So the terminal cash flow is the sum of the differences in net operating working capital for all those years, minus the shutdown expenses, times 1 minus the tax rate, which we don't have any of listed here, plus the salvage value, minus the taxes on the salvage of the new machine. Okay, but really, all we're looking at is the salvage value here. You know, I'll make this blue. In this example, all we're looking at is the salvage value and the effect of gaining back the working capital that we originally invested in, right? So let's say you've just been carrying this extra $3,000 worth of inventory relative to what you used to have, and then at the end of the day, you're gonna get rid of that along with everything else when you use up the new machine. Okay, so really, our terminal cash flow is going to be $18,000, right? Our salvage value and the working capital. And let's see, recoup. Now, why aren't these taken as after tax? Because these are not operating revenues, right? This does not go on the income statement. It goes on the balance sheet. Basically, getting the value of a piece of equipment that we have. So this isn't an income statement thing, so we don't pay taxes on it. Neither the salvage value nor paying back our original increase in raw materials. So our terminal cash flow is simply the sum of these two in this example. Okay. Make that bold. All right, so now let's set up a timeline. And in your book, and I believe when you did capital budgeting project in your other finance class, you ran the years downward, and that certainly is efficient in its use of sort of screen space. But I like running the years horizontally because sort of from a logical perspective, it makes more sense. When you make a timeline, you make it horizontal, right? So let's look at then these cash flows on a timeline, right? Okay. We'll say cash flow. So at time 0, year 1. And let's see if we can fill this out. 2, 3, 4, 5. So at the end of time. So at time 0, we spent negative $62,680. In time 1, we gain a benefit of $24,000. We can make that an absolute cell reference and carry that across. Carry that across all the way to year 5. And then in year 5, we also have a positive terminal cash flow from selling the equipment. So these are our cash flows from this project. Okay, I've got them set up in a timeline. Now, I'm going to stop this video here, and then we'll talk about how to determine whether this is a good investment or not.